Hey, what's going on, everybody? Welcome back to another episode of Wealth Defense Radio, the podcast. I'm your host, Josh Inahosa, and I'm an independent advisor representative for SWAN DFW. That stands for Sleep Well at Night, Dallas-Fort Worth. And I am here with two guests this week. One is the one that you all are familiar with, and it is Hector Inahosa. He's a certified financial planner who started SWAN DFW a while ago and has been doing this for an even longer while.
That's a lot of while.
It is. And our other guest is my brother Caleb. You will know him as the editor slash producer slash technological genius of the show. And he is making a special appearance because he is in town from New York City.
New York City? Get a rope.
Yes, from New York. So, I'm on the podcast today with you both because sometimes I think when you guys speak, you guys both know the language of the financial world. And I think it would be good to answer some questions for someone who is not in the financial world.
Nah, that'll never work.
Okay. So what we're going to be talking about today, specifically, we're going to do a podcast for young people who are self-employed.
Okay.
Or not necessarily self-employed, but people who don't get benefits from their jobs.
All
so
right.
I am one of these people. So if you are a self-employed person, say someone working in the arts or someone even working in a situation that just your job, like a fast food restaurant or
Service
something
industry,
that doesn't have benefits for your life, what would you guys tell someone who is over the age of 26, so they're off their parents' health insurance? What is the way forward for someone who's looking for health insurance but doesn't have it?
Well, the first thing is healthcare.gov is like the marketplace for health insurance. That's the first place you should likely go. If your job does not give you insurance, you can put in what you want, what you're looking for. I think you can put in a price range, and it'll just pop out, hey, these are all the different options of whatever. And you can go in and compare and look. And that's like the first step on like actually purchasing insurance.
And so are these government health insurance policies, or are they just a distributor of private?
The health insurance actually comes from an insurance company. They are sold through and subsidized by healthcare.gov, the Affordable Care Act. As we speak, towards the end of 2025, some of the subsidies have not been extended. So I'm not sure.
What does that mean?
One of the hardest things that the Affordable Care Act solved was a health insurance policy for somebody in their 40s or 50s would cost about $1,000 a month. That's usually way more unaffordable than people can stand. But it's cheaper for America to have people have health insurance so they don't end up at the emergency room where it gets really expensive for us to treat them. So the Affordable Care Act came along and said for people under these making incomes of this or less, we will subsidize some of that $1,000. And so some people could buy health insurance, still the $1,000 policy, maybe spend $100 or $200 a month, but the $800 a month subsidy was coming from the government to make sure they could afford it and make sure that they had health insurance. And it wasn't bad health insurance. It wasn't great, but it wasn't bad. It was health insurance. Again, those subsidies have gone away, and so we don't really know, looking to 2026, what that's going to look like. I suspect we're going to get some kind of subsidy extension just because it's so important for families to have health insurance, especially when you have little kids and stuff like that. So, but Josh is right. That would be the first place I would go, is go to healthcare.gov, see if you qualify, and try to get health insurance that way. The other thing that one might look at is, and they're a little harder to find, are what are called catastrophic policies. That means that they're only going to kick in. You really don't have any health insurance for the first $10,000 or some amount, $7,500 to $10,000 of something huge, catastrophic happening. But if you take let's say that somebody's going to pay health insurance of $500 a month, you would have spent $6,000. Most people only have between $1,100 and $1,500 a year on an average year of health costs. Going to the doctor a couple times, you may have to spend $100, $150 to see the doctor without a copay and stuff like that. But it's way less than $6,000, which would have been the premium at $500 a month. So buying some kind of catastrophic insurance would be another place to look at if the ACA wasn't available.
Okay. So that didn't really make sense to me.
Okay.
So explain to me what, in the most basic terms you can explain,
Okay.
what does health insurance do?
Okay. Let's say that I was paying $1,000 a month.
Okay.
Okay. And I had what's called a deductible, and we'll call it $2,000.
Okay.
Okay. And I had a copay of say $25.
Okay.
Okay. So I'm going to pay $12,000 in this year for health insurance.
$1,000 a month.
$1,000 a month, $12,000 a year. Mm-hmm. So let us say that I had a cold, and I went to the doctor. Mm-hmm. The doctor's visit really costs about $150, $175.
Sure.
But because I have a copay of $25, I pay $25, and the insurance pays the balance, well, a discounted rate to the doctor. But the doctor only charges me $25.
So I'm paying the doctor or the insurance company $25?
You're paying the doctor the $25. That's called a copayment.
Okay.
The other copayment comes from the insurance company. That's going to go to the doctor.
Okay.
Okay? That's copay. Now let's say that I fell and broke my arm. Mm-hmm. Now, and I went to my doctor who's got a minor emergency situation there. Okay. Still going to have, when I see the doctor, I got my $25 copay. But now with x-rays and settings and all of that, I'm going to spend $8,000 for a broken arm. Mm-hmm. And I'm just making these numbers up. After the copay, I've still got to put $2,000, because that's my deductible, before my insurance kicks in. So I have an $8,000 bill, mm-hmm. and I'm going to spend $2,000 of it before I even get to my insurance. The deductible part is my part. Now I got $6,000.
So wait. Why did I only pay $25 for a doctor's visit, but when I broke my arm and it was much more expensive, I needed to pay $2,000? Why isn't it still just $25?
Well, you did. You paid the $25 to see the doctor.
But then to fix it?
And then all of a sudden he's saying, okay, we're going to need x-ray. Assuming that everything is going to happen in his office, and that usually doesn't happen, but for simplicity's sake, everything's going to happen in his office. Mm-hmm. And now he's saying, okay, we need to take this test, we need to do that test, we need to take this x-ray, we need to put this pin, we need to do the whole bill, $8,000. Mm-hmm.
Okay.
All right. Now my deductible is $2,000.
Okay.
And I pay the $2,000, and that leaves $6,000 for insurance. Okay?
So, okay. But why wasn't the copay... I paid the copay. So copays are only for a doctor's visit.
Doctor visit, right. That's just
but anything that's actually a procedure,
right?
You have to go into your deductible.
Yeah, that's correct.
So health insurance ensures that you're only going to pay $2,000 maximum?
No. That's just your deductible. There's another number called maximum out of pocket. We're getting there. So I had an $8,000 event. I had a $2,000 deductible. I got $6,000, right?
Say that one more time.
Okay. I had an $8,000 event.
Yes.
I had a $2,000 deductible.
Which I paid.
I paid. So now there's $6,000 in play.
Okay.
My insurance happens to be an 80-20 plan.
Okay.
It means the insurance is going to cover 80% of whatever is left after the deductible. So the $6,000, mm-hmm. they're going to cover $4,800.
Okay.
And I'm going to have to write another check for $1,200.
To the doctor.
To the doctor, or depending on how it's billed, it's going to be sent to somebody. The doctor may bill it, the insurance company may bill it. It's very convoluted about how that happens. But the important thing to remember is on this 8,000, I had a $2,000 deductible, and then $1,200 or 20%.
I have to pay 20% of what's left
Yeah.
after the deductible.
Right. And so now this $8,000 event cost me $3,200.
Plus what I'm paying every month.
Plus
which
what I'm
was
paying-
$12,000 a year.
Which is $12,000 a year.
So some might say,
Some might.
if I promise to live healthily, it would be cheaper just to pay the $8,000.
Some might say. Except for, say that you got cancer. That's $1 million event. Right. You're gonna have to save a lot of $12,000 a year to come up with $1 million.
But I also can't pay 20% of $1 million, even
Right.
if I do have health insurance.
in our example, so how an insurance company protects you is they have the third number that's important. You have the copay, you have the deductible, and then you have what's called the maximum out of pocket. And let's say that my maximum out of pocket is $5,000.
Okay.
So on that, going back to that $6,000 event, let's make that a $20,000 event. Now I had to pay the $2,000 deductible. That left $18,000 in play. I had to pay 20% of that
18,000.
18, which is 3,600. Except for when you add 3,600 to the 2,000, we're at 5,600. My maximum out of pocket was 5,000, so I'm going to just write a check for 3, and that's all I'm going to pay for the rest of that year. Everything else is going to be covered at 100%.
So January 1, I break my arm. It costs $20,000 or whatever.
Yeah.
So I have to pay $3,600 on my, $2,000 on my deductible,
And 3,000 for your max out of pocket.
because that gets me to $5,000 that I spent over the year.
That's right.
So then if I get cancer, for example,
You get
everything's covered as
You're-
long as I keep up the monthly payments.
That's correct.
But it restarts every year.
Every January 1st.
So then I
Do it
next
again.
year pay $5,000 for my millions of
Right.
dollars of,
That's right.
but I'm also still paying the monthly.
That's right. So you're still $12,000 is your
So I'm paying $12,000 plus whatever my
5,000.
maximum out of pocket fee is, and that's better.
If you have a catastrophic event, absolutely that's better.
So you were talking earlier about catastrophic insurance
Yeah.
is different than regular health insurance.
Yeah. What instead of $12,000, making up a number, let's call it $100 a month is your insurance payment, right? You go, well, that's a good deal. Well, hold on. And it is for what insurance is supposed to do. So you're going to pay $1,200 to have catastrophic insurance, and what catastrophic says is
$1,200 a year.
a year.
Okay.
Means you have no insurance basically until you get to some number. Let's call it $7,500. $7,500 is your magic number. You're going to spend, if you had that broken arm, you're going to spend all of the $6,000 or $8,000, right? Because let's call it $10,000, so that you're going to spend all of that because you didn't have insurance until $10,000.
Okay.
So, but if you do get cancer, then at $10,000, depending on how this insurance is structured, let's say that it's 100% after $10,000, then everything is covered. So now instead of spending $12,000 a year just for insurance, then deductibles and co-pays and all of that, you're paying $1,200 with the maximum of another $10,000 if something catastrophic happens. Could be a car accident, it could be a disease, it could be any number of things. And so, that was another way that we used to have to try to solve this insurance problem, because it really gets really tricky.
So do you recommend to people who are in their 20s, late 20s, because they're off their parents' plan, to seek out, in general, if they're a generally healthy person, to seek out a catastrophic plan or a normal plan?
Affordable Care Act is the first place I would go.
So the first place you go is healthcare.gov, see what the cheapest insurance plan is that fits all your criteria of what you think you might need.
Yeah, and your criteria should be very little. Just get insurance. Just get insurance. Make sure that you get a doctor that you can see, and you're going to be miles ahead of anything else. Bankruptcies in America, something like, I forget what the number is, something over 60%, 60 to 70% of bankruptcies in America used to be medically related. Mm-hmm. You're rocking along, everything's fine, you're not paying insurance because you can't afford it. But then something happens. There's a car wreck, or there's a disease, or a stroke, or a heart attack. And you have these bills you just simply can't afford to pay. And that drives up an individual, or worse, a family, into bankruptcy. And that's a hard thing. So any protection that you have is better than none. But I understand young people saying, I never get sick. And we pray that you never do. But if you do, it's worth it to have some insurance. It just is. It's a very grown-up thing to do. It's like you're becoming an adult. And I know that if you didn't make that $100 or whatever it is payment, you could afford a nicer car or a nicer apartment or nicer clothes. But insurance is one of those things that everybody hates until you need it.
So at the end of the day, you're saying just suck it up,
okay,
get insured.
That's right.
I think what we say about life insurance is kind of true about health insurance also, where it's like, even if you just have a little bit, that is generally going to be better than having none.
Yep.
Right? So if you even find a health insurance plan that maybe instead of the $1,000 a month he said is a couple $100 a month, it's good to have in your back pocket in case something catastrophic ever does happen, or in case you get an illness that you need to go to the doctor a lot, or you need a lot of procedures, or whatever that might be. It's better to have a little bit than none at all.
Yeah, because a young person, let's just do life for a minute. A young person gets something hard, diabetes, any number of diseases. That has changed that person's life for the next 60, 70, 80 years. If on top of that you pile on a massive amount of debt for medical or bankruptcy, if that's the worst thing, now you've not only complicated his life with a disease that he's going to have to manage, now you're not going to have any credit or buying a home or a car or even getting nicer apartments. Everything gets sucked down by not having that. So that's why a little bit, even if it's not the best insurance, something that works. Just like you say, suck it up and go get some. I would tell that even if you were my son. Oh wait.
Josh, take us away.
Yeah, so if you want to talk to Hector or I about any of the things you heard on this podcast or anything retirement related, we have a couple different ways that you can do that. The first way is via phone number, and that is 888-792-6339 or 888-SWAN-DFW. And the second way is via email address, and that is info@swandfw.net. Caleb, our editor, is going to put both of those on the screen as I would have said that, and they will be in the description wherever it is you're watching or listening.
He's going to put it on the screen if you're listening?
Well, it'll be in the description wherever you're watching or listening.
Very good.
All right.
All right.
Thank you guys for watching, and we'll catch you on the next one. The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.